How can the stock market be worth $50 trillion while entire nations drown in debt? How can the S&P 500 celebrate record highs as 60% of Americans live paycheck to paycheck? This isn't growth, it's theater. The illusion of wealth now floats above a collapsing foundation. Corporations valued higher than countries, digital assets exceeding the worth of all real goods combined, a fantasy sustained by printed money and blind faith. This isn't growth. This is the final stage of an economic mirage, an empire built on paper wealth, not reality. For decades, people have believed the stock market was a reflection of a nation's economic strength. Rising indexes meant progress. Falling markets meant crisis. But that relationship no longer exists. Today, the market has detached from reality, an elaborate illusion of prosperity built on speculation and artificial liquidity. Take NVIDIA. In 2025, the company reached a market capitalization of around $4.4 trillion, greater than the entire GDP of Japan, more than India's economy, and larger than the combined market value of every company in Switzerland. NVIDIA, a single chip manufacturer on paper, is worth more than all US farmland and represents nearly 15% of the value of all gold ever mined. It's absurd, yet celebrated. This is not the triumph of innovation. It's the triumph of distortion. A valuation this inflated doesn't represent production, employment, or real wealth. It represents financial hallucination. The numbers have become abstract, detached from human labor or tangible output. The stock market has evolved into a self-referential system, driven by algorithms, leverage, and the relentless flow of cheap money. The so-called Magnificent Seven – Apple, Microsoft, Amazon, Alphabet, Meta, Tesla, and NVIDIA – now command over $19 trillion in combined valuation. That's more than the combined GDPs of Germany, Japan, and India. The market worships them as economic gods. Yet their rise has less to do with broad growth and more to do with capital concentration. A few companies consuming the financial oxygen of the planet. These numbers are not signs of strength. They are warnings. The market has become a mirror reflecting not productivity, but monetary excess. For years, central banks have flooded the system with liquidity, turning capital into a speculative drug. Investors no longer chase fundamentals. They chase liquidity. Price no longer means value, it means velocity. We are witnessing a global financial mirage. The charts rise not because the world is producing more, but because the printing press never stopped. Money, detached from meaning, continues to inflate digital assets while the real economy, manufacturing, labor, agriculture, flatlines. The illusion of prosperity is the greatest deception of our time. Numbers rising in a collapsing world. The illusion of prosperity did not emerge by accident. It is the calculated result of decades of monetary manipulation, financial engineering, and political complacency. What looks like unstoppable growth is, in truth, a system addicted to intervention. The roots trace back to 1971, when the Bretton Woods system collapsed and currencies were unchained from gold. From that moment, money was no longer a measure of value. It became a tool of control. Governments could print without restraint, and central banks could fabricate liquidity to maintain illusions of stability. But the modern distortion truly accelerated after the 2008 financial crisis. Facing systemic collapse, central banks unleashed a flood of digital money through quantitative easing and near-zero interest rates. These were sold as emergency measures. Instead, they became permanent policy. Trillions of dollars were created with a keystroke and injected into financial institutions, corporations, and government bonds. Yet this liquidity never reached the real economy. It was trapped at the top, circulating between banks, hedge funds, and asset markets. Economists call it the Cantillon effect. Those who receive new money first benefit most because they spend it before prices rise. By the time it filters down, ordinary citizens face inflated costs while their wages stagnate. This structural bias created two economies, one built on inflated assets and leveraged speculation, and another struggling under debt and declining purchasing power. As financial markets soared, the real economy, Factories, small businesses, workers was left behind. The wealth gap widened not through innovation, but through policy. Low interest rates acted like steroids for speculation. Capital became almost free, and risk became irrelevant. Instead of funding innovation or infrastructure, corporations borrowed to buy back their own shares, reducing supply and artificially boosting prices. The appearance of prosperity was engineered, not earned. The system is now locked in a feedback loop. Central banks print money to support markets. Markets rise to justify the policy, and the illusion continues. The mechanics of the madness are simple. Liquidity replaces productivity, debt replaces growth, and faith replaces value. This is not capitalism. It is financial alchemy, a global experiment sustained by confidence alone. Once cheap money flooded the system, it had to find somewhere to go, and it didn't flow into productivity, innovation, or infrastructure. It flowed into speculation. Corporations discovered that in this new era, financial manipulation was more profitable than real work. Instead of building factories, developing technology, or hiring workers, many corporations borrowed billions at near-zero interest rates to buy back their own shares. Each buyback reduced the number of shares in circulation, automatically pushing stock prices higher. No new value was created, yet executives and shareholders grew richer. This was not market growth. It was numerical surgery, carefully designed to inflate perception. Between 2010 and 2024, U.S. corporations spent over $7 trillion on stock buybacks, more than the GDP of Germany. The practice, once rare, became the default strategy. The illusion of success was rewarded. The substance of progress was ignored. Wall Street applauded the deception because every artificial gain fed the larger bubble of confidence. Even companies drowning in debt joined the game, issuing bonds to repurchase their own equity. Credit rating agencies looked away. Central banks, obsessed with market stability, ensured that the cost of borrowing remained negligible. In this environment, failure became impossible, not because businesses were strong, but because the financial system refused to let them fail. This was the birth of a new kind of capitalism, one that no longer allocates resources based on merit or efficiency, but on access to cheap credit. It is a system where the price of money dictates the price of everything, and where survival depends not on productivity, but proximity to liquidity. Meanwhile, authentic innovation became secondary. R&D budgets stagnated while balance sheets ballooned. Corporations mastered the art of appearing healthy, while hollowing themselves out from within. Profits were engineered, not earned. The era of financial engineering turned global markets into a stage production, a performance designed to preserve faith in an economic order that no longer functions. The world mistook motion for progress, price for value, and illusion for achievement. What began as a rescue operation after crisis has become a mechanism of control, a self-sustaining illusion that rewards manipulation over creation. The financial engineering that inflated corporate wealth also created a trap, an invisible cage around investors, institutions, and even governments. Everyone inside the system knows the truth. The valuations are absurd, the fundamentals are weak, yet no one can step away. Because withdrawal now means destruction. In a 2024 Bank of America survey, 91% of fund managers, controlling nearly $500 billion in assets, admitted that U.S. equities are overvalued, but they remain fully invested. Why? Because central banks have erased the concept of safety. When cash yields almost nothing, holding money becomes punishment. The market has become the only oxygen available in an economy starved of alternatives. This is not confidence. It is coerced participation. Every investor, from pension funds to sovereign wealth funds, is forced to feed the machine to survive. If they stop, the illusion collapses. If they continue, the bubble expands. The system depends on its own denial. Interest rates, though rising in recent years, remain historically low relative to inflation. Bonds no longer offer real returns. Savings lose value in real time. The traditional balance between risk and reward has disintegrated. In this distorted landscape, speculation is not greed, it is survival. The market no longer rewards intelligence or strategy, it rewards obedience. Algorithms trade billions in microseconds, amplifying volatility and divorcing prices from reality. Financial models built on assumptions of infinite liquidity sustain the illusion that growth is perpetual. Every temporary dip is instantly rescued by policy or intervention. Risk has been nationalized, gains remain privatized. Even professional investors know the system's fragility, yet they cling to it. Pension funds, retirement accounts, and institutional portfolios are now tied to inflated equities. A correction of even 20% would erase trillions in paper wealth and ignite global panic. The system cannot correct itself. It must be sustained by force. This is the ultimate trap. A market too inflated to fall, yet too fragile to stand. The illusion of prosperity has transformed into dependency. Investors are no longer participants. They are hostages in a financial experiment with no exit. And the longer this illusion continues, the more devastating its end becomes. While the financial elite celebrate record highs, the consequences of this artificial prosperity are written in human struggle. The same liquidity that inflates assets suffocates ordinary life. What enriches the few quietly dismantles the foundations of the many. The result is a society split by design, a world where asset owners live in a parallel economy. Their wealth multiplies through inflated markets, while those without assets drown beneath rising costs. This is not inequality by accident, it is inequality engineered through policy. The Cantillon effect, once a technical term in economics, has become a lived experience. Those closest to money creation, banks, corporations, hedge funds, receive it first and expand their wealth before inflation appears. By the time it reaches workers, the price of everything essential has already risen. Food, housing, healthcare, and education all become more expensive, while wages stagnate. The global middle class, once the stabilizing force of democracy, is being erased. Home ownership, the traditional path to security, has become a luxury. In the United States, corporate landlords now own over 40% of new single-family homes in major metropolitan areas. Families compete not with neighbors, but with institutions backed by unlimited credit. Meanwhile, the younger generation faces the bleakest odds in modern history. Trapped in debt, priced out of housing, and paid in stagnant wages, they inherit an economy designed to extract rather than empower. The promise of upward mobility has been replaced by permanent precarity. This economic fracture is reshaping politics itself. As the gap between perception and reality widens, trust collapses. Populism rises, not because of ideology, but because of despair. The stock market becomes a symbol of corruption, a scoreboard of inequality where gains are privatized and losses socialized. The system feeds on silence. As long as prices rise on screens, the suffering below remains invisible. But the imbalance cannot be contained indefinitely. Every distorted gain is borrowed from the stability of tomorrow. The longer the illusion persists, the greater the reckoning will be. The cost of this financial architecture is not measured in points or percentages. It is measured in lost homes, broken trust, and the slow disintegration of the middle class, the true casualty of the world's most profitable illusion. A system built on illusion cannot withstand reality for long. Beneath the surface of record highs lies structural fragility, a market so overextended that it now survives only through perpetual intervention. What appears as stability is dependence. What looks like resilience is denial. Every cycle of quantitative easing, every artificial rate cut, and every corporate bailout has weakened the immune system of the global economy. Risk has not disappeared, it has been buried. Yet buried risk does not vanish, it accumulates silently, waiting for a trigger. That trigger could be anything: a sharp rate hike, a major debt default, a geopolitical conflict, or the failure of a key financial institution. The catalyst is irrelevant, the reaction is inevitable. When liquidity tightens or confidence cracks, the illusion unravels. The same leverage that magnifies profits on the way up magnifies destruction on the way down. The scale of potential collapse is unprecedented. Global debt now exceeds $320 trillion, more than 3 times the world's GDP. This means every dollar of real output supports $3 of borrowed illusion. When interest costs rise even slightly, entire sectors become insolvent. Corporations that lived off refinancing cannot roll over debt. Governments dependent on deficit spending face fiscal crises. Consumers already over-leveraged buckle under higher payments. The supposed resilience of the modern market is a myth engineered through monetary anesthesia. Central banks have become the markets themselves, buyers of last resort, liquidity providers, and crisis managers. But their tools are losing power. Every new stimulus buys less time. Every rate cut produces smaller gains. The system now requires infinite support to maintain finite growth. Even minor disruptions now ripple globally. A bank failure in one region triggers panic across continents. An energy price shock cascades through supply chains. Confidence evaporates faster than liquidity can be replaced. The illusion of safety has created the certainty of vulnerability. What looms ahead is not a normal correction, but an unavoidable reckoning. A return to equilibrium after decades of artificial expansion. The danger is not just the fall itself, but the collapse of faith that follows it. When people stop believing in the system, money ceases to function as trust. And without trust, no market, no government, no civilization can stand. What we face is no longer merely an economic imbalance. It is a civilizational distortion. When markets abandon truth, societies abandon purpose. The financial system that once existed to fund progress now consumes it. Money has become detached from meaning, and in that detachment lies the root of collapse. For centuries, value was tied to production, innovation, and tangible contribution. Today, value is defined by price movement alone. We no longer ask what something creates, only how much it trades for. A stock that rises is deemed successful, regardless of whether it employs, builds, or benefits anyone. This inversion of logic turns speculation into virtue and labor into irrelevance. Central banks, originally designed to stabilize economies, have become engines of distortion. By guaranteeing liquidity at any cost, they have rewritten the laws of capitalism. Risk has been erased, accountability dissolved, and the link between effort and reward severed. The invisible hand of the market has been replaced by an algorithmic hand that prints value from nothing. The consequences are not confined to balance sheets. When money ceases to represent real work, trust disintegrates. Citizens lose faith in governments, institutions, and ultimately in the concept of fairness itself. Economic inequality becomes not just financial, but existential. Proof that the system rewards access, not merit. The moral corrosion is subtle yet devastating. Corporations now measure success not in service to humanity but in quarterly stock performance. Governments chase GDP growth built on debt rather than production. Individuals are taught to speculate, not to save, to trade, not to build. The culture of creation has been replaced by a culture of extraction. Every civilization eventually confronts this question. What gives its money meaning? When the answer becomes nothing, collapse follows. Not through violence, but through loss of belief. The stock market's euphoria amid social decay is not a paradox. It is the final symptom of a system that values illusion over reality. We are witnessing not just an economic transformation, but a moral inversion, where paper wealth outweighs human welfare and algorithms dictate destiny. The next crash, when it comes, will not only mark the end of a financial cycle, it will mark the reckoning of a civilization that forgot the purpose of value itself. The numbers will keep rising, until they don't. The screens will glow with record highs, even as the foundation beneath them rots. The system will celebrate its own illusion until belief itself becomes unsustainable. When that moment comes, the correction will not be financial, it will be existential. The collapse will not destroy wealth, it will expose what was never real. Behind every inflated chart lies a truth no algorithm can erase. No empire, no currency, No market can outlast the reality it denies. The stock market may soar above the world, but gravity is patient, and reality never forgets.